All right, we are live. What's going on, party people out there on the interwebs? A couple important things I would say to address today. I've got a lot of people who are asking me about credit scoring, credit scores. We're seeing a lot of people who are trying to get into the housing market. A lot of people are sort of waking up to the reality of what happens when you rent and get in the habit of renting. And I'm going to make a video later this week about when it's okay to rent and how to rent effectively if you're going to do it, what reasons are okay to do it, etc. So I'm going to break that down because there is a better way to rent versus not. But a lot of people are waking up to this, and a lot of people are trying to get approved, and some of these people don't have their credit in order yet. So I've got a couple of credit tips that everyone can use, everyone can share, everyone can apply. There's nothing hidden here. There's no fee. There's nothing behind the curtain. So we got that. And of course, I want to talk about mortgage rates, and give you kind of some bad news. So we've been watching this very carefully. I'm gonna zoom in a little further. You see here we've had these two lines, which I'll draw more exactly here. You can see this. This is the 50-day moving average, and see how it kind of flatlined right there. And then this is the 25-day moving average, and see how this kind of flatlined. And basically we had a squeeze. So there's a squeeze here where you go, all right, this is going to break out one direction or the other. And remember, higher prices in bonds is what we want because this means lower interest rates, okay? So we're hoping for higher bond prices. And unfortunately, what happened here in the squeeze is we had a bad day yesterday, really bad candle, and then today we dropped even further. So now we're underneath these two important moving averages. We have those as ceilings that are resistance now. Now, of course, anything can happen, and we do have the Federal Reserve on our side, and so this may not last, but right now it's kind of bad news, probably heading to this support level here, or potentially even this support level here, which means in the short term, we'll see rates probably get a little bit worse. There are still instances, depending upon what the spreads look like, whether or not an individual person who's in a purchase transaction or someone who is looking to refinance should float or not, because it still can make sense to float right here, depending upon what the spreads look like. I'm floating several locks right now as an example, even though it looks like things may get worse. I don't think it'll last. I don't think it will last, because at the end of the day, we still have the Federal Reserve on our side doing a lot of things to boost bond prices and therefore reduce interest rates. But if you do have a question about anything mortgage related, give me a call. I know I kind of hide behind my lower third. Hello, it's Wilson here, the mortgage professional. So it's Derrick Evans, NMLS 155010. My huge lower third. I've got a huge lower third. But that's just so that you have my contact information. You can reach me if you have questions. Someone who's trying to utilize the VA home loan benefit, someone who has a VA interest rate in the 3s. You should really be looking to refinance now. Because there's just still really, really low rates on the government side. It's really conventional rates that we're seeing that are affected by this. But people who are VA can still get like 100% cash outs, even with 680 credit, up to 2.75%. I mean, still really, really, really good opportunity. So let's take a look at sort of my purpose today for making this video, which is more based around the concept of people needing help with credit. And there's a couple of things that I really want to lay out for you here, and I want to tell you why. Not just what they are, but why. I have a tremendous amount of experience with this, and I know this stuff works. So one of the big things here is auto loans. A credit score wants to see an auto loan on your credit report that has activity in the last 6 months. Number one reason people who are good stewards with their credit see their credit score drop is they pay off an auto loan and then they check their credit 6 months later. Now, 6 months after you've paid that thing off, you don't have activity on that account in the last 6 months anymore. Therefore, the credit scoring model is not giving you credit for it ultimately, and it's not giving you active credit for it. And therefore, your credit score can go down. Because remember, there's two ways that the credit score can go down. You can either have a negative item show up on the credit report, right? Negative item can show up on the credit report that didn't exist before, or a positive item can be removed. In both of those instances, you're going to see your credit score go down. So if you don't have an auto loan, here's my hack. Auto loans are good, okay? Here's my hack. And I've done this many times to help many people do this. A lot of people who don't have great credit scores have a car that they own free and clear. Remember, the credit scoring model doesn't care about the quantity of numbers. You have a collection for $5 or $5 million. It hurts your credit score the same. You have an auto loan for $5,000 or $50 or $500 or $50,000. It doesn't matter. it helps your credit score the same. So what you do is you take your paid off car, you go to the credit union, get a $500 auto loan for 2 years. It doesn't matter how big it is. And then you basically, what I do is set up an account at the same credit union or bank, doesn't matter. Set up an account there for a savings. Let's say your $500 auto loan over 2 years, you're paying back $570. So they're getting $70 of interest off you for the next 2 years. What you do is you go ahead and put $570 in that savings account, and you set up auto pay. So it auto pays from that savings account to the auto loan account every month. You don't have to touch it. There's enough money in the savings account just to pay the auto loan off, and then it'll be depleted. And you'll have 2 years there of building good credit history without having to do a thing, and only costing you $70 at the end of the day. So because what you do is when you get the $500 from the auto loan, you use that you put into the savings account, and then you add in the interest yourself. So you put in $70. You don't need a lot of money to do this. But especially if you don't have an auto loan, this will boost your score a ton. If you're in the 500s, a lot of people who are in the mid 500s, high 500s don't have auto loans. Get one, and you will see a big difference very, very quickly with that. Okay, so that's a huge hack that everyone can use. This one is my ultimate secret weapon. So I'm going to try to establish this based on timeline and help you understand kind of how this works. So we're going to pretend that this is a timeline here of the month, and most people will, they'll get their credit card bills and then they'll pay them off, and they'll tell me, I pay my credit cards off every month when I get the bill. I pay it off, so I should have great credit. Here's the problem, and here's the bad news, and don't shoot the messenger. You're not getting credit for it. And the system is set up this way on purpose so that you won't get credit for it if you're using the card again the following month. A lot of us do this. We're told this. Use the card, pay it off every month. Use the card, pay it off every month. So the credit bureaus and the big banks, they set up the system for credit scoring, is particularly the FICO score, which we use for mortgage, to take advantage of that mindset, to take that common knowledge and use it to their own benefit. So here's how it works. Let's say your statement ending date, and you need to know this for every single card that you have. Let's say your statement ending date is the 20th. Okay? So what happens is when the 20th rolls around, all right, whatever balance you have on that day is what shows up on your bill, right? So when the 20th comes at the end of that day, on the 21st, the next day is when they send you the bill, and they tell you how much you owe, and they tell you what the minimum is, and so forth, right? You get all that information on your bill. The thing is, they also, on that same day, they send it to the credit bureaus. So the credit bureaus are seeing your account on the worst possible day. They're seeing your account on the day that you're going to pay it off, right before you pay it off. So they're looking at you, and they're taking a snapshot of your credit profile at the worst possible time, because in case you didn't know, the lower your credit card balances are, the better your credit score will be. So you want low credit card balances for higher credit score, okay? That's important. And everyone knows that, but not everyone knows how this little thing works. So here's what you do, especially if you've set this up on auto pay a couple days earlier. If your statement ending date is the 20th, then go ahead and pay your card off on the 18th every month and set yourself a reminder. Or most of these cards will give you the option to set up auto pay, and you can select pay the whole balance or pay the minimum payment or pay a different amount, and you can set it up automatically. Set it up automatically to pay the card off, or whatever amount you want, whatever amount you can afford, to pay that amount, because this doesn't just affect if you're paying the card off. It affects if you're just paying the card at all. So set it up to on the 18th. Statement ending date is the 20th. Your homework is look up your statement ending date on all your cards, know when they are. Set a reminder for yourself, or set up auto pay for 2 days before that. Okay. So now what happens is on the 20th, you have a what? You have a zero balance because you paid it off on the 18th. So what happens? The bill that they send to you says you have a zero balance and you have zero minimum payment. And also the information that gets sent to the credit bureaus says that you have a zero balance and a zero minimum payment. So now you're finally getting credit for the payments that you've been making on your credit cards. If you were just paying them when you got the bill, whether you're making minimum payments or you're paying extra toward the minimum or you're paying them off Doesn't make any difference. Whenever you get the bill, if you're paying it then, you are not getting credit for it. You're just not getting credit for it. The only way you get credit for it is if you don't use it the next month, and then you have the same balance again when that one gets reported. That's the only way you get credit. So if you're using your credit cards regularly, which a lot of us are because we get points or we get whatever, we want to have a good credit score, just make sure you use this hack. Make sure you pay a couple days ahead of the statement ending date. Okay? If you pay a couple days ahead of the statement ending date, you will in fact see your credit scores go higher, because they can't go lower based on this. This is something that can only help them go higher. You don't have to pay any more money than you already planning on paying. It's just about when you pay it. Okay? And a lot of times too, they'll ask you when you open a card, when would you like your statement ending date to be? Do you care? This is something you can actually choose. So if you need to change it for pay periods or whatever it may be based on when you get paid and so forth, call them and ask them, can I change my statement ending date? Can I change my statement date? And just see if they'll work with you on it. Sometimes they will, sometimes they won't. You know how credit card companies are. So that's my hack. So for now, biggest things to keep an eye on. Stock markets seem to be relentless, but today faltered at the end. So we're going to keep a close eye on that. I am going to do a video about renting and how to rent effectively, how to rent smartly. If you need to rent or you have to rent for some reason, how to make sure that you're doing it wisely so that you can still maintain a home ownership strategy even if you're renting. So that video is coming. More information on the stock market is coming as well. Hopefully we'll see bonds turn around, but if things really get ugly, I'll let you know. Right now we haven't seen a huge impact in rates. Maybe lost 0.25%, maybe 0.3% from the lows. So still in very, very good shape there. Still amazing rates to take advantage of. But right now bonds are going the wrong direction. So for people who may think, oh, well, rates are going to be low forever, that may not be the case. You never know. Who knows? They go up, they go down. Right now, we know they're in very good shape. So I would suggest taking advantage of that, especially on the refinance front. Get a quote, whether it's with me or someone else, it's fine. But get a quote, see if you can save some money, do the math. If you need me to look at any paperwork for you, I'm happy to do that anytime. Give me a call. Let me put my giant lower third on the screen. Call me, text me. Happy to look at anything for you. If there's any way I can help you, I always will do that. That's what I'm here for. And hey, let's share this video. Share this video with your friends. Let's help make them smarter than everyone else. Thanks for tuning in.